Welcome to my channel. With over 20 years in the finance industry and teaching at a top Australian university, I bring significant industry experience. I'm a CFA charter holder and hold two master's degrees in finance. I am here to make finance concepts easy to understand. Today, we are exploring the capital asset pricing model or CAPM. It's a fundamental concept in finance that helps investors understand the relationship between risk and expected return from an investment. Think of CAPM as a way to figure out if taking a risk with your money is worth it. It's like deciding whether to keep your cash in a super safe place where it grows a little or putting it into something like a new company where you could either make a lot more or lose it. CAPM helps investors see how much more money they could make by choosing the riskier option. There are four key parts of CAPM. The risk-free rate, which is like the guaranteed money you could get from a super safe investment. The risk-free rate is like the minimum reward you'd expect for lending your money to someone very reliable, like the government, without worrying about losing it. It's like a starting point for comparing how much more you should earn for taking bigger risk. Risk-free rate is the minimum return an investor should expect. Usually, 10-year government bonds are used as a proxy for risk-free rate in these calculations. Beta, which is measures how much an investment returns might fluctuate compared to the market. Beta tells us how a stock or investment moves compared to the whole market. If beta is more than 1, the investment is like a wild roller coaster, going up and down more than the market. If it's less than 1, it's more like a ride with not too many ups and downs. It helps investors figure out if an investment is riskier or safer than putting their money in the whole market. Market return is the average earnings from the stock market. In CAPM, market return represents the average return investors expect from the overall market, like a stock index. It's a benchmark for assessing how well an investment does compared to the broad market. If the market's doing well, investors expect higher returns from their investment to justify the risks. When the market's down, the expected returns might be lower. It's all about comparing what you could earn from your investment versus what you'd make from just going with the flow of the market. Expected return is what you hope to make on your money when you invest, considering the risk you are taking. Let's simplify the CAPM formula. Expected return equals the risk-free rate plus beta times the market return minus the risk-free rate. This equation helps us figure out if the extra cash we could make from an investment is worth the additional risk compared to the just playing it safe. The CAPM formula helps you figure out if an investment is worth it. It combines a safe bet, that is risk-free rate, how the investment moves with the market, that's beta, and what everyone expects to earn from the market, that is market return. In simple words, it tells you the extra money you should get for picking a riskier investment over a sure thing. It's like deciding if the extra cash you might earn is worth the extra worry, helping you choose wisely where to put your money. This equation calculates a return one should expect on an investment, considering its risk compared to the market. It's a practical tool for assessing whether an investment is worth its risk. Imagine a scenario where the risk-free rate is 2%, the market's average return is 10%, and our investment has a beta of 1.5, signaling higher risk. Using CAPM, we calculate an expected return of 14%. This means for the extra risk, we are looking at a potential 14% gain on our investment. Now, let me explain it in simple terms. Imagine you have some money and are thinking about two ways to use it. One is very safe, like putting it in a bank where it grows a little bit, say by 2%. The other way is to invest in a company that could do really well or not, which is riskier. Now, the average good result for risky investments like this is about 10%. But the company you are looking at is even riskier, 1.5 times more than usual. So you use capping formula to figure out you might make 14% instead of 2% or 10%. This means if you are okay with the risk, you could end up making a lot more money. CAPM is like a tool that helps investors pick which stocks to buy, decide on their investment mix, and give businesses corporate finance advice on where to put their money. It uses a formula to weigh the risk against potential rewards. But let me tell you, it's not perfect. It has limitations because it assumes things like everyone having the same info at the same time and the risk, that is beta, not changing, which isn't always how things work in the real world. Plus, estimating how well the whole market will do can be tough. So while CAPM is super useful, it's also important to remember it has its limits and to use it as just one piece of the puzzle when making financial decisions can be challenging. We end our video here. If you guys have any questions, just leave a comment. Thanks.